Today on the CEO Barbecue, we're talking royalties, and more royalties together with EMX Royalty Corporation and Elemental Altus Royalties. If you want a bullet point summary of this conversation and all the other CEO barbecues in your inbox once a week, go to researchtalks.com and subscribe to our free newsletter. Now, the company you're about to hear from has paid us for the production of this video, which means that this is not research, it's an advertisement, and you should treat it as such. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. And please only watch this if you absolutely know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, and my business sells content-producing services, which also makes me biased in multiple ways. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital might be at risk. If you're not 100% sure you understand 100% of the disclaimers I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, this is where I normally dive into some of the numbers behind the company that's being interviewed, as well as some of the trading data and whatnot, but that doesn't really make too much sense in this scenario because these two are merging. More specifically, it was on September 4th that EMX agreed to a merger with Elemental Altus, where Elemental is going to acquire all of the issued and outstanding shares of EMX for a 0.2822 Elemental Altus shares for each EMX share, resulting in a 51-49 ownership split for Elemental and EMX respectively. The new company is going to be renamed to Elemental Royalty Corp with 3 Elemental Altus board members and 2 EMX board members. Dave is going to be the CEO and Fred will be the COO of the newly merged company. Together with the transaction, Elemental Altus is also doing a financing, but an interesting one, which definitely raises some questions because it's Tether, a private stablecoin crypto company doing that financing. And it's not a small financing either, as they are buying 75 million shares of Elemental Altus at $1.84. So that's nearly, let's call it 140 million Canadian dollars. So a big financing there. And the merged company is expected to have 200 royalties in total, 16 of which are already producing. And the analyst consensus is that they will be able to do $80 million, and that's $80 million US dollars in revenue for 2026, 2/3 of which stemming from the precious metals portfolio and 1/3 from the base metal portfolio. So as you can imagine, I do have a lot of questions, and that means it's time for me to shut up already. And gentlemen, let you do the talking. But first of all, thank you for being here today.
Thanks. Yeah.
Pleasure is mine, and I am looking forward to the conversation because when Dave, when you and I spoke back in February, you told me that you were trying to buy back as many shares as you could at the time, not issue new ones, unless what you at the time called an unbelievable opportunity walked in, and I'm quoting on that one. So how or why did a share-based merger here in this case make more sense for EMX shareholders instead of continuing to buy back stock and maybe do smaller cash deals down the line?
So just to make sure we understand the anatomy of that, Antonio, and thank you for that question. First of all, we were buying back stock at a dramatically lower price than we are today. We knew that we were trading at a fraction of our net asset value per share in a situation where our net asset value per share, as defined by the analysts, was moving upward consistently year after year. And those percentages of upward moves were salient. So our net asset value per share is moving up, and we're buying back shares down here. That turned out to be an astonishingly astute decision. We ended up buying back over 6% of the issued and outstanding shares of the company and erasing those shares. Furthermore, just to define the anatomy, so we understand. So Elemental issued shares at a premium to buy EMX. So the merged company is formed by Elemental Altus issuing shares to buy EMX, and then we're merging that together. My pleasure to have the opportunity to work with Fred and the team. So just want to get that statement correct. And also you pointed out that Tether was buying in at $1.80 per share. It's actually $18 per share, as those shares have now been consolidated, which is why the share ratio that you mentioned previously was 0.282, just to make sure we're all on the same page, if you don't mind. Because I know you like to get the details correct because you always grind me on those. So I'll point those out. Yeah. And you might ask, I'm sure the next question is, why now and why are you doing this merger? And it might be an overused phrase, but 1 + 1 = 3. We've had a long time to get to know the Elemental Altus guys. Keep in mind that the Altus, a significant portion of the assets in Altus were part of a Michael Wynn company. Michael Wynn's our chairman. So there's a long history there. Michael Wynn was on their board of directors. So we've always had a strong element of communication with Elemental Altus way back to the Altus days and prior to that, Legend Gold. That has resulted in us looking at many opportunities over the years to syndicate. Most of those opportunities were failed, which is the right way to do business in our business. And that is to look at a lot of opportunities and fail them. We shared due diligence costs and we shared business acumen in regards to those analyses, and thus got to know each other quite well. We think there's an excellent cultural fit. And then we did syndicate the purchase of Caserones, which for both companies and now the combined company is a very important asset that we have on the books here. It's exposure to an immense copper molybdenum system operated by Lundin, and they're pouring money into the ground to create more resources and reserves, which is why we own royalties. That's just one of a couple of different sister royalties that the companies have, which look very, very nice together. And the overall portfolio merged together looks, well, it separates us from the crowd, we'll say. There's a fact within the royalty space, and that is that the more royalties you own, the more they're all worth individually. And the way that that is actually actuated in the market is in net asset value multiple. So Franco Nevada and the big three trade at commonly 2 times NAV5 on a per share basis. When we were separate companies, we were trading at a discount to NAV, which is frustrating. And thus, that's why EMX was buying back stock, right? Which was the right thing to do, wholeheartedly. We believe that we can increase our NAV multiple upwards towards 1.5, if not 1.8, in addition to the net asset value growing on a per share basis. So we're really exposing our shareholders to a nice opportunity here, bringing together 2 teams that have different backgrounds but are quite synergistic, and ever expanding the amount of discovery optionality and production optionality within the portfolio. The market has told us that they really appreciate what we're doing.
There's loads in there that to get into, and Fred, I'll give you the word here in a couple of seconds, but I suppose in the end, it does come down to valuation, right? And maybe you can talk to me more about that as well. Here, Dave, from your perspective, I believe EMX shareholders, again, will own 49% of the combined venture, but you're bringing more than half of the immediate revenue. And then you're also, I mean, depending on how you would value TMOC, you would also bring more of the NAV here, if I'm not mistaken. So how did you come up with that valuation? 49-51 split is almost effectively a 50-50 split, but then at the same time, not really. So yeah,
once again, I'll just to make sure everybody understands the numbers exactly. It's EMX gets close to 50%, 49, 50% is right in that number. Let's call it 49. And then Elemental in its current state, plus the $100 million investment from Tether equals 51. So the 51% from the Elemental side, for those people that care about these numbers, what I care about is a company that looks good going forward and we're going to do great things. That's more important. But you're zeroing in on the percentages. I just want to make sure we all understand. So the Tether $100 million investment plus Elemental Altus is 51% and EMX is 49%. Now, coming back to what is accretive for both sides. It's accretive for both sides, clearly, because of the portfolio effect moving forward. And when you grind into the details, which of course the bankers love to do, EMX is contributing greater NAV because of the long-lived copper assets that we have exposure to. And copper assets with very long lives commonly trade at a lower NAV multiple in the market. Elemental's bringing in more near-term gold production. EMX is adding that, but more so long-term copper production. So those can be valued differently in the marketplace. Neither of us were receiving the proper value that we deserved as separate companies. Together, we're going to get that and more. If that helps answer your question. So it's accretive to the Elemental shareholders on a NAV basis. It's accretive to EMX on a current cash flow basis and on a gold to copper ratio basis. And it's accretive to both companies from a portfolio allocation or portfolio effect basis.
Definitely.
Did I say that right, Fred?
Sorry, Antonio?
I
think
explained that properly.
Yeah, no, like I think it makes total sense. And if you look at just the share prices since announcement, looking at it today, I think EMX is up 40% since announcement. And the other thing that we don't cover it as much, but I think is really important as well, is the combined liquidity. And I know for Elemental Altus, that was always, we had a very tight register. We had some very big shareholders, and that was really good in some regards. And in other regards, such as liquidity, actually, it is sometimes a hindrance. And if you look at the combined entity, the liquidity we've had is already orders of magnitude greater than what it was individually. And when we have the US listing, which we're planning to have prior to this deal closing, and then we come as a combined company onto that US listing, I think our liquidity will be even better. And if you have greater liquidity, it's easier to trade. You generally have a lower cost of capital as well, as alongside all the benefits that Dave talked to in terms of diversification and a larger portfolio. And so I think that combined entity is going to be much more attractive for investors who are looking for a really material royalty and streaming company in the space who have the liquidity and enable them to participate in a meaningful way.
I think the combined company now, just to continue on with you, Fred, here, the combined company will also have a new partner, again, a bit of an orthodox partner, if you say, like a crypto mining company, no, not a crypto mining company, maybe not yet, but a crypto company coming into mining, into gold and base metals as well. How come? And I guess this is more your domain, but what's the strategic angle here, and how does having Tether on board make sense for Elemental Altus and soon Elemental Royalty Corp?
Look, it's a really good question. Probably not one that either Dave or I had on our bingo cards for 2025. But I think what's really fascinating about Tether is that if you look at their own account attestations of what is in their holdings, I think they have acquired nearly 20 tons of physical gold so far this year. And to put that into perspective, that would make them one of the largest single purchasers of physical gold after a number of central banks in the world. And so clearly that is a cornerstone shareholder who is looking to increase their exposure in the gold space. And the royalty and streaming model is a fantastic business model that gives you direct exposure to the commodity prices. It gives you uncapped optionality going ahead for decades and decades. And you can have such a diverse portfolio of interests and all that optionality that is embedded within it, that it's a really good, smart way for them to play the market and increase their exposure in the gold space. And coming out of this transaction, there'll be an approximate 33% pro forma shareholder. So I think for us, it's great because we know going forwards, not only will we have $50 million coming out in cash on the close of this transaction approximately, we should also be able to upsize our credit facility, which is currently completely undrawn. We should be able to upside that on the basis of our revenue profile to probably $200 million order of magnitude. So we'd be coming out of this with the ability to deploy maybe $250 million of non-dilutive capital between cash and credit facility. We have a major shareholder who is so far in the first half of this year, one of the largest buyers of physical gold in the world. And they are a 33% shareholder. I think they're going to continue to support us going forwards in terms of acquisitions, any deals that we do need to do. So it puts the company in a phenomenally strong position to continue the growth, both organically and if we need it, with the support of some really key shareholders. And that's probably also one other point worth touching on, is that EMX and Elemental Altus, we've always had quite a strong overlap of some cornerstone shareholders. And there's a few groups in there that have been very supportive for the company. Talk about the Paul Stevens and the Extract Capitals and Sprots of the world. But some of those groups have been very supportive in getting the companies here, and I think aligned in the philosophy and approach we take of actually trying to have accretive growth and not just growth for the sake of it, but really making sure that whatever transactions we do are adding value to the company at the same time.
Does it also provide the opportunity for the company to switch from smart casual to hoodies and Crocs because it's a crypto company now?
Yeah. Not sure we've covered that point on the integration work so far.
We don't have ties on today.
Yes. One step at a time.
Yeah.
Dave, talk to me a little bit about what you think about what Fred just said, because again, just from your perspective, having built this royalty company in a traditional way for over 20 years now, I believe.
We're
This
going
is a
23 years.
completely new, yeah, exactly, and a completely new angle, right? So how do you think about it? How do you view it?
Well, we've always believed that astute gain of scale was smart, right? And we've always been the value players on the block, or certainly consider ourselves to be that, looking for the bargain basement opportunities, in addition to things that we pay up for that add to the top of the pyramid to gain scale. This is an opportunity to do that to a whole nother level. We have done two corporate transactions earlier in our history, so this will be our third in 23 years. So we've always had this approach that we're willing to look at M&A and corporate transactions as a method to help gain scale to the business, but want to be very smart about it. I believe this deal is exactly that. And I agree wholeheartedly with all the points that Fred made. Mm-hmm.
How much control do they have as a large shareholder? How often, Fred? How
Well,
often do you
usually it'd
talk to
be
them? And
33%, but they have a strong presence and the chairman of the incipient board.
so,
To factually answer your question. That being said, from a conversational perspective and a strategy perspective, we find them very open to learning more about the mining industry. They want to learn from our collective team's experience and utilize their desire to invest within the space and our expertise to build an even better company.
mhm. What I'm really asking about there is yes, strategy. So from the perspective of the whole kind of tech or crypto world, they value things in multiples, whereas we in mining, we value them based on how big is the discount, because there's almost always a discount to mining assets. So strategically, how much of a say do they really get, given that again it is you two that are the mining brains essentially, and everyone else in the team. But they are a large shareholder. So yeah, how much of a say do they get in situations like that?
I'm not sure I fully understand your question, but I believe the gist of it boils down to that they understand the value of hard assets. That's why they're buying gold. That's why they're buying farmland, and that's why they own T-bills. Mm-hmm. And what's the next best thing to own, or maybe even better than a bar of gold in the bank, is a gold royalty, because gold royalties have optionality at no cost to the royalty holder. And that's why Pierre Lassonde, used the term "the gold investment that works" for Franco Nevada in the early days, and that has absolutely come to fruition over the decades that Franco has been built, and other royalty companies as well, and we're on our way. So it's this whole concept that royalties are phenomenal financial instruments because of embedded optionality, price optionality, but more importantly, discovery optionality, which results in production optionality moving forward. That really drives the value of these assets. And so when Juan and Tether look at this and they say, holy smokes, we're buying farmland, we're buying physical gold, we should own royalties. And what's the best way to own royalties? Let's help build a royalty company that was trading below NAV, and we're going to get them to where they're trading above NAV, and we're going to increase NAV per share. Mm-hmm. That's the right strategy.
Well, don't worry about it, Dave. Most of the times I don't understand my own questions either, so you're not alone.
Well, I hope I had the gist of it.
And maybe, Antonio, if you were asking along, I think one of the inferences was how involved are they in decision making and strategy, and maybe a good illustration of that is this transaction, because we've talked to the point that we actually started this conversation in 2024, and in the shareholder circular and documents that will come out, it will show that we've been discussing this and looking at the merits of it for a not insubstantial amount of time. And I think having Tether's involvement was actually very helpful for that, in giving us a cornerstone shareholder going forwards who really wants to grow it and back it. But these discussions we've been having now for over a year to get to this stage and make sure that it really makes sense and it fits. And if you look at we announced two transactions 48 hours before we announced this merger. And actually, one of those we had been talking to for quite a long time as well, in terms of the Elemental Altus management team, and had been working on that deal for a while, and another one. So I think in terms of our ability to go forwards, it actually means that we can go even further and even faster when we see an opportunity we really want to take advantage of. And having the confidence of knowing that we got a really supportive major shareholder behind us when there is something that we have conviction on, we can push the button on it, which I can tell you certainly from the Elemental Altus side was not always the case when you're starting off small and actually your biggest constraint is access to capital. And you can find a great opportunity, but you might not actually be able to execute on it. So that is a huge difference, game changer for us, I think, going forwards, and for combined entity, a whole nother level.
Yeah. I think you've told me that story before, Fred, where you essentially started the company with $1 million. It was the two of you, two guys essentially who started. So it is a huge change. I mean, $140 million. When that comes in, how much money is the combined company going to have on close?
So we'll with the $68 million in acquisitions that we are simultaneously doing, and also paying down the Franco credit facility with EMX have. So we'll have one combined credit facility subsequently. We will have approximately 50 million US in cash on closing. And then we're obviously extremely cash flow positive, even more so at today's prices. And sometimes can't quite keep up week to week at the moment, month to month with where the prices are. But one of the wonderful benefits of having a cash flowing portfolio with direct exposure to the commodity prices is every week, every month, those commodities are trading at these prices. We capture the benefit of it straight away. So we're going to be in an increasingly strong cash position on close. And I think then, as alluded to at the moment, we will have a $50 million credit facility with National Bank, CIBC and RBC on our side. And on close, I think we'd look to increase and expand that credit facility. And based on the pro forma revenue, you could probably quite easily support a $200 million order of magnitude size credit facility.
What's it going to take for you to get to a point where you're investing off of your balance sheet, where you don't need credit facilities or loans or capital raises in any way anymore? What's it going to take for you to be not only a cash flow positive royalty company, but also a royalty company that can, again, grow on its own?
Both of us have already done that with moderate and small size deals, and we'll have the ability to ever increase our arrows in the quiver to be able to accomplish that as our cash flows increase.
I think it also comes partly to your ambition and what how you're valued and the relative discussion there. And so it's always I don't think it's that is a discussion that evolves month on month when we're looking at the opportunities and we're looking at the funds we have available. And if we see some fantastic opportunities that are going to really drive value, then at least now we're in the position we know we could raise more money and do it. If we think actually there's so much value in our stock, as Dave said in EMX at the beginning of this year, when I think you were probably trading below $3, Dave. And maybe I put Canadian, but I think you saw the best thing to do was just repurchase your own shares there actually as the most accretive one, and you're probably up 160% or so since then. So clearly,
since then, yeah.
So clearly different times to adopt each strategy, and I think it will partly be the opportunity set. But Dave mentioned earlier, one of the synergies or one of the benefits maybe of this deal is actually having the two combined teams being able to look at twice as much deal flow and cover twice as much ground. And so that's something that earlier today, actually, we had a call working across opportunities, and I'm not sure how far down the list we made it. We certainly didn't make it to the bottom, but it's a pretty good sign when there are more opportunities and there are people in the company to review them.
Is an NCIB going to be the mandate for the newly formed company on day one as well, or in the future of the company? How do you see that?
Fred, would you like to address that? I guess we had the NCIB in place before. Did you have one, Fred? We put one in place?
We did set one up for the first time around the middle of this year. We've never actually used it yet. And we've also, one of the challenges of an NCIB is sometimes you're so in possession of material information that you can rarely adjust it, put it in place or change it. So short answer is we have it, but we just haven't used it yet. So the combined company should have an NCIB in place, and then it will be up for the new board to determine the best timing and use of that going forwards.
Yeah, and I think philosophically, just to add to that, it's always good to have the NCIB in place so you can execute if there was a situation where you thought it was appropriate. The overall strategy from my point of view of buying back our stock when we're trading at 0.5 NAV or less, which is where we were at, it was a no-brainer, right? When we're trading up towards 0.8, 0.91 times NAV, and we're looking at a plethora of opportunities to conduct accretive deal flow, then that puts us in a different situation and probably would not be as aggressive on the NCIB. Mm-hmm.
What is that sweet spot? What's that discount that makes it, makes you want to buy your own stock instead of look at other stuff? Is it a 0.5? Does it get a little bit higher than that?
There's a lot of variables in that equation, right? So you have to look holistically at all the opportunities for that capital. And so there's a lot of variables that would go into that. And yeah, I'm sure you can envision that, right? So it's comparative of if you do X with capital versus Y versus ABC. And both companies have a long track record of allocating capital appropriately. Dave, it was a no-brainer when we're trading below 0.5 NAV to buy back our stock. Yeah. And that's been proven, right? Because as I said, we've three-bagged the stock since we did that. So yeah. But today we bring in $100 million and come out of this with a strong balance sheet.
I was going to say that, though not a very good one, I am an accountant by education, so I want fixed numbers. It's 0.7, I buy back stock. It's 0.8, I don't buy back stock. Doesn't always work like that in mining, though.
You have to compare what other things you would do with that capital, right?
Yeah.
So if we have a chance to buy some phenomenal thing that comes in the door, even if you're trading at 0.5, you might do it, right? Yeah.
Franco, by the way, on that topic as well, I wrote it down and otherwise I'm going to forget here, but I believe they still have in the money warrants, if I'm not mistaken. Any
Yes.
idea what they plan on doing with them? What's that relationship going to look like once you've paid back that debt?
So yeah, Franco, long-term friends of ours and supporters of EMX. They were friendly and supportive for me long before they were shareholders. They ended up syndicating the Caserones purchase with us and became a shareholder. They've given us our blessing with respect to this deal. We actually had to have their approval because of the debt and the covenants associated with that debt. So we will pay off that debt. We've had meetings with them. They've congratulated us. And I believe it's very likely that they will remain shareholders in EMX. Their warrants expire in a little over 1 year's time.
Right.
They have shares and warrants.
Yeah. And so the idea is
roughly on a go-forward basis, they'll be a little over 3% fully diluted.
But the idea is that they remain a shareholder in the company. That's that's your expectation, essentially.
Yeah, that's our expectation. Yep.
Okay. Let's maybe talk a little bit about strategy here for a minute, because this deal would put you both very comfortably in the mid-tier range. How do you grow from here on out, though? And I'm asking broadly first, maybe, and then we can narrow it down. But what does it take to grow a mid-tier royalty company into a major? Is it just having a lower cost of capital? Is it having that deal flow? Is it a combination of it all? Yeah. What does that look like?
So I'm going to let Fred answer that question, but first I'm going to make the big picture point. Our goal is not to become a major royalty company. Our goal is to make money for shareholders. Right. So we're here to invest astutely and create value. A lot of people talk about how we're filling a gap in the space between juniors and there was a vacancy there. Okay, that sounds cool, and bankers like to talk about that, and analysts like to talk about that, but I don't really care. What I care about is that we're growing a portfolio that creates value for our shareholders, that translates to a long-term compounded annual growth rate of our share price. But with respect to the strategy as to how we grow the company, I'm going to let Fred answer that question.
Well, Dave actually took the big picture point that I was about to start with, which was the assumption, the premise that we need to be a major, because I think that actually it's really driven by the opportunities and creating value. And sometimes I think if you can take $1 million, if you could take $1 million royalty and turn it into a $200 million royalty without doing anything else, maybe you shouldn't do anything else. Maybe you should just sit on that one royalty. So look, in terms of where we are, I think part of the reason the combination worked is because we've got a similar philosophy in terms of not chasing growth just for the sake of it. Mm-hmm. I mean, obviously there are some benefits that come with it, and we're seeing it here with increased liquidity and size and ability to talk to larger investors. But the fundamental premise has to be that the actual assets are additive to each other. And here we both own part of Caserones. We both owned part of the Cactus royalty. with Arizona and Sonoran, and there's actually two other smaller royalties we both owned part of that I was reminded at Beaver Creek. So there's a couple that cross over, but it's in terms of growth, it's from here looking at what makes sense, and that can be anything from early stage assets all the way through to producing. I don't think that range of what we're looking at has changed. It's really still the same analysis that we're trying to do in terms of what actually adds value to the company and shareholders and makes sense, but that we're in a very much stronger position to do it.
What do you mean you were reminded of royalty? You don't know all 200 royalties off the top of your head?
It's funny, but I remember years ago meeting the CEO of one of the mid-tier royalty companies, and I asked him about a specific asset in their portfolio, a small one, because there was actually another part of that royalty available. And he was adamant that they didn't own the royalty. And I'd got it wrong. I knew they had because we've been working on it. But I sort of thought, how can you not know every single royalty to granular detail that you own? And I think now with this deal closing, we're probably going to have 220 odd royalties, 210 odd royalties. I think I'd like to think I would recognize everyone, but will I remember some of the granular details about them? Maybe not as much as I did when we only had 4 and we were a 3 million market cap private startup.
A similar story to what Fred said. I heard David Harkle one time give a presentation to a big group in Vancouver, and he said that some of the best royalties they have on the books today, he didn't know the name of 5 years prior. And that's because of deep portfolio discovery optionality. So royalties that you hardly remember that you own, all of a sudden there's a drill hole that hits. The next thing you know, it's turning into a major deposit. That's why you own royalties right there. And that's part of the portfolio effect.
The best example of that, Dave, is some of the ones where it's not even the right commodity that they were buying the royalty for initially. But it's suddenly actually a different commodity altogether. The discovery is made, and suddenly they've got an incredibly valuable royalty that no one not only foresaw, but no one even anticipated.
So a fun recent example of that is the Vitangi royalty that we own in Sweden. That was originally a copper prospect. There was a geophysical anomaly from an electrical method that was utilized. It turned out to be a false anomaly related to graphite, not copper. So it was originally a copper prospect that was completely defunct. It was sold a couple of times. The royalty remained in effect. It turned into one of the most significant advancing graphite deposits on the planet that we have a royalty on now. So, phenomenal example of exactly that. That's why you want to own royalties. They're perpetual lottery tickets.
But that is also why, Dave, you've always wanted to have more optionality through your royalty generation business, which you've done a lot of, and that was part of your competitive advantage, I believe, as well. What's going to happen to that business?
So that business will remain strong, and I'll point out that Elemental and Altus have a background in royalty generation as well, and the prospect generation business model. We believe that's incredibly astute allocation of capital. And the team that executes that model and the secret sauce actually comes from the synergies between royalty generation and royalty purchase and strategic investing, because that puts smart economic geologists and engineers that are making business decisions and making observations about how the industry is working in mineral belts around the world, gives us a leg up with respect to being able to do due diligence, and a specific leg up in regards to sleuthing and discovering of royalty and investment opportunities that are not going through sales process. And that's the secret sauce. If we go back and we look at the return on purely royalty generation, it has a positive expectation. If we look at buying royalties to gain scale in the company and adding to the top of the pyramid, has a positive expectation. But where the huge wins come is the integration of the two, where the teams find a royalty that you can buy. And of course, the preeminent example would be buying the Timok royalty for 200,000 Canadian dollars that now has a analyst average NAV of 260 million and growing. And that's the secret sauce.
I'm going to try and ask one of those questions where I may not understand the question myself in the end, but I'll try. I'll do my best. Does doing that still make sense for the size of company that you're going to become eventually is what I'm thinking. So do you think that becoming a larger royalty company might be costing you sort of your competitive edge in the market, where you didn't have to compete with bigger companies on your royalty generation business and on bigger royalties because it was yours? And so being a bigger company now, wouldn't that mean the royalty generation business is sort of less efficient in terms of value generation, and couldn't that essentially erode that alpha there?
Well, I think you know my answer to that question. So I'm going to hear Fred's. But before Fred answers the question, because I want to hear him answer this,
Yeah.
I want to point out that Franco Nevada specifically, and that's one of the largest royalty companies in the business, invested in EMX because they wanted exposure to that side of our business. So that answers you whether or not that makes sense for larger companies to do royalty generation or have exposure to that type of deal flow. So that's the one data point. But I want to hear Fred's answer to the question, if you don't mind, Fred.
Yeah, well, it's an interesting one because actually one of our newest producing royalty on the Elemental Altus side is actually one that originated with EMX's current chairman, Michael Wynn, many years ago through Legend Gold. And that is a Corrali Sud asset that is part of Allied Gold's tier one geological deposit, Sadiola in Mali, over 10 million ounces there. And that royalty went all the way back through the prospect generating arm for many years. And as that came into a mine, it was a great partner for us to put the royalty into their hands with a combination of milestone payments and also a 3% royalty initially, dropping down to 2% uncapped forever royalty on it. And I think if that 10 million ounce, we say this internally, if that 10 million ounce deposit was in a Canada or the US and it had been a public company forever, that royalty would probably attract order of magnitude greater value. Because it's been a private company up until very recently, there's actually not nearly as much knowledge and awareness of that project. But we really like the exploration optionality that we get with that. And I think that, look, one of the maybe two things to just touch on other than that, which is one of the ones Dave mentioned, which is always trying to find royalties off-piste, is a phrase we use internally, which is not ones that are brought to you and sort of, but ones you actually go out and generate and you find yourself. And in that sense, actually having people on the ground in the flow, knowing what is going on with projects, exploration, new discoveries and mines, that's incredibly valuable for us because there's always a danger as you get bigger. I think that you end up sort of trapped in a corporate office, siloed from actually where the real exploration and discovery work is going on in the ground. And I think having people with that technical background, and you mentioned earlier starting the company with Richard Evans and Peter Williams on the Elemental side years ago, and both of those, Richard is a geologist, 30 years plus experience at Western Mining. Peter was a geophysicist by background, 30 plus years Western Mining, both with experience with prospect generators. A few of our other directors subsequently also experience with prospect generators. And I think having that really technical background to the company was critical when we started. And I think that going forwards, one of the areas that EMX was best known for and where they were undoubtedly the strongest in that junior royalty space was on the technical side. And so actually that gives us a really, really strong addition in terms of our ability to evaluate deals and do it efficiently and quickly. Because part of the challenge is there are so many opportunities. You have to use your time efficiently and you have to really make sure you're identifying the best ones quickly. And so having a combination of teams there, I think is really valuable, having that presence on the ground in multiple countries, that network. And it can be understated, but a lot of our deals have come through network, through other people in the industry who have said, yeah, we think this is a great project. It looks like a great discovery. Have you looked at it? And not just the existing asset, but you can look in the area, you can look at other projects. I would say most projects nowadays have a third-party royalty on them. Probably 70% of all projects have a third-party royalty on them somewhere along the way. So there's a huge sort of pool of existing opportunities there to look at. So that's really important. And then the other part I think you touched on as well, which is the size and scale. But some of the team were just doing a site visit since we announced a merger on a new potential royalty generation opportunity that actually does have some really meaningful size and scale. Just on that one. So I think there's a whole range that you can do, but I think that it makes sense on a number of fronts for us. I think that we've got the benefit of it today in one of our producing assets. And I think that the technical skills the EMX team have are going to be incredibly additive to our existing business development team on both sides and enabling us to cover more ground.
And it seems like that technical skill is focused on precious metals and base metals as well. And you're about 2/3 precious, as I mentioned earlier. The rest is base metals. Is that where you want to keep it? Or do you expect an increase in any of them?
Well, my patent answer to that and my fundamental value and belief around this topic is that we want to be exposed to prospective mineral rights. And that's the key thing, because we want to be exposed to discovery optionality, because that's how you separate yourself. And that's why royalties are amazing, because that discovery optionality, of course, translates to increased production over time, right? And so the key thing is expose ourselves to prospective mineral rights. The world will consume as much copper in the forthcoming 20 or 22 years as we have throughout all of human history. That's a conservative prediction based upon current macro mineral economic analysis. If you want to summarize all that, as Bristow, the former CEO of Barrick, said, gold's the most precious metal. Copper's the most strategic. They're great metals to be exposed to. Our view, big picture, is that copper's good, gold is great. And we probably will do our best to aim that gold plus silver is 50% or more of our revenues. But we fully want to be exposed to prospective mineral rights.
What about competition? Dave, you and I have talked about this. I think the last time you and I spoke about this, but I asked essentially, what about competition? Competition in the gold and silver space is way higher. There's virtually no competition in tungsten and zinc and bauxite and whatnot. Is that something that might be of interest, or will it still remain on that end?
We look at those opportunities. Occasionally, they come across our desk. They're happy to take a look at them. But the fundamental criteria is, is it astute allocation of capital?
The tungsten, you mentioned tungsten, that's an interesting one, because we bought a tungsten royalty last year. And actually I can, there were some shareholders who liked it and some shareholders who didn't like it because they sold tungsten initially. And they were wondering if it was a pivot in strategy, but it was simply a value decision. We saw the deposit, it's Fireweed who are advancing the project. And Lundin's obviously major shareholders there alongside our Caserones royalty. And that is a project that rather uniquely has had about 7 years of permitting historically in Canada. So it has been through that really long time frame already. And on the basis of the previous work done, and they're updating it now, but on the basis of the previous work done, I think it would have repaid us almost our acquisition cost on an annual basis for 30 or 40 years based on the resource at that point. So it's going to be, I think, an incredibly valuable royalty when they update the project later this year, coming out next year. And that was only available to us because it was tungsten. Had that been a gold deposit with similar economics, with similar potential and optionality, we would have had to pay orders of magnitude higher price for it. And because we're in I think the really beneficial position of having the majority of our portfolio in gold and copper, it gives us the flexibility to go and take advantage of an opportunity like that, where it's not going to suddenly change the weighting of our portfolio, but it could actually be really meaningful in terms of value created. And part of that is because, as you said, there's just less competition and less people, I think, looking at opportunities like that sometimes.
Yeah, that's absolutely true. I used to talk to the Fireweed's previous CEO, Brandon McDonald, and he used to say that his job would be orders of magnitude easier if he was pitching a silver or a gold asset. Instead, he was pitching zinc and tungsten. And I actually went to see Mac Tung this year in the Yukon, and it was incredible to see everything up close. So yeah, that's the deal that I had in mind when I was asking this question there.
So, there you go.
Yeah.
Yes. But we're yet to get to site, but hopefully can follow in your footsteps and get a site visit out there shortly.
You'll enjoy it. It's higher up, which means fewer mosquitoes. It had the least amount of mosquitoes there relative to all the rest. So I did enjoy it. And they give a really wonderful tour of a large land package and everything. So I think you'll enjoy it. And obviously, the next best thing would be to watch my video from there. A bit of a personal plug there. What about jurisdiction, though? I mean, you're reminding me of or I'm reminding myself of jurisdiction. You mentioned Mali there, and you made sure to emphasize on it being a tier 1 geological deposit, because the jurisdiction sure isn't. But geologically, Sadiola, all the discoveries in that greenstone belt have been tier 1. Well, most of them, not all of them. So yeah, where do you go as a combined company? What's the focus going to be?
Go ahead, Fred. You're in Mali.
Okay, well,
I was in 20 countries, but Fred should answer the question.
And look, I mean, Dave's got a long history of working across the globe in different countries, particularly Turkey. But I think one of the ways we tried to think about it internally was balancing the geological potential with the jurisdiction risk. And our view starting off was that we were likely to see, this is at a high philosophical level, we were likely to see less greenfields opportunities in unexplored opportunities in West Australia or in Canada in some of the famous gold belts. And we would likely be looking at more brownfields opportunities or assets that have already been explored partially. Whereas we could go to some emerging jurisdictions and actually you're looking at a mine that is starting with a 10-year mine life. But actually we could see that going for many decades beyond that because it was a grassroots project. Right. So I think for us, we could see an awful lot of geological potential. And some of our licenses that we have got in emerging jurisdictions have been very large land packages, hundreds or even 1,000 square kilometers, which is sometimes, again, hard to get in the middle of much more established gold belts. So we did that, but we have also, along the way, we have turned down some opportunities that we liked the potential of from the operator counterparty and the geology perspective, and we turned them down because we thought it would make us overweight a certain jurisdiction or even a certain region within a jurisdiction. And so always back of our mind, the operator, the country, the balance of our portfolio across it. I think today we're incredibly diverse. I mean, if you look at our portfolio, we have Europe, South America, North America, Australia. It's really more diverse than any other company sort of within our region. And I think a number of them have a focus in sometimes the Americas, sometimes Australia, but rarely across the whole spectrum. And I think EMX have a almost unique portfolio exposure to certain European opportunities, projects as well. But maybe I'll hand over to Dave there for anything you'd add.
Yeah, I'll just say a couple of big picture points. I agree with everything you just said, 100%. And some of the things that Fred's been articulating point out exactly why we want to work with them. So, we really see clearly this path forward from the same viewpoint. But I'll point out something that Rick Rule often says, and that is that, rocks don't change, but politicians do. And the political risk in the mining business is different than political risk in other businesses. And the larger risks in the mining business are engineering and environmental and geologic risk, particularly when you go to the early stage, right? But we read about political risk in the newspaper every day. And so commonly people are keenly aware, if not over aware, of political risk factors because they're being put in our face. Turkey is a good example. I've worked in Turkey for a very long time. It's a very comfortable place to work. But I commonly hear people that, reference some of the movies made in the past about Turkey, which were exaggerated, et cetera, et cetera. But anyways, the point being is that there's an arbitrage there. You can capture great geology with vastly less competition because of perception of there being risk factors that maybe don't exist. Long story short. And EMX and Elemental have taken advantage of that in building our portfolios over time. The other thing I'll point out is that Dr. Richard Chodeh, an advising macro mineral economist to our company, just recently published a century compendium of exploration and discovery data in a recent Society of Economic Geologists report. That's a very nice piece of work to go back and review. And there's a number of trends there. Some of the trends are discoveries being made at greater depth, the amount of money that's going into exploration and discovery around the world, where the destination of those monies are going, and where discoveries are being made. So a lot of the huge discoveries that were made decades ago were in Anglophile countries, Canada, United States, Australia. Now we're seeing a trend of more and more major discoveries being made throughout the globe and more far-flung from some people's perspective jurisdictions. These are all trends that we as a royalty company want to be in front of.
Well, as you mentioned earlier, you have a larger combined team now, but you still have more opportunities than people to look at those opportunities essentially. And Dave, this is something you and I have talked about before. You explained it to me back then as well in terms of the accounting and everything. But sort of the biggest criticism that I've seen so far of EMX since you and I have been speaking has been the size of your G&A. And that is related, is again, you've explained to me, to your prospect or to your royalty generator model. Will the combined company have a lower G&A than the sum of the parts? Is there any efficiency to be had there?
We're expecting to save millions of dollars, but we've not yet given guidance to exactly what that is. Going back to the first part of the question, a significant component of that is a difference in accounting technique of doing royalty generation, where 100% of EMX's expenditures in the royalty generation world are expensed each quarter, whereas most royalty companies capitalize their expenditures when they buy royalties. And EMX does that as well, as does Elemental. When we buy royalties, we capitalize all of the costs associated with that, as well as the purchase price itself. So if a royalty company is only buying assets, they're capitalizing all of that. It goes as book value for that asset on the books. EMX has over 100 mineral assets on the books at zero book value because all of the expenses related to creating those assets were expensed each quarter. So part of that analysis that you've mentioned to me and other people have mentioned to me for years is because of a difference in accounting technique, because of a difference in the business model.
It's kind of like if you have a restaurant and you have a cook come in to make a recipe for you, you have to pay them. And if you pay them right now for the recipe, so you make that expense right now, but you're going to make money off that recipe potentially down the road. That's kind of how I look at that.
Okay. I've not heard that analogy before. I remember it.
Is that right? I mean, is that fair?
Yeah, that's fair.
Okay.
Yeah.
Okay.
Yes, in both cases, you're paying up front, but yeah, accountants love to capitalize stuff so they don't have to talk about how much money they spent, right?
Exactly. Yeah, exactly. You'd think my wife might be an accountant, but she's not. Options, insider compensation and everything, kind of like it's a bit of a housekeeping note that I have on here. Going forward, how is that going to be determined? How, for the combined entity, what are the KPIs going to be that you're basing off incentive?
Look, I think all of those, Antonio, still to be worked on by the new comp committee and the board. So I think that part of the job here is to integrate the teams, align the strategy, and make sure everyone knows what we want to achieve and what everyone's role in that. And then flowing from that is some of the parts you talked about. So I think that similar to some of the more detailed metrics on the numbers going forwards, I think we're about just over 4 weeks post announcement now. I think today, and I think that we had the week and a half or so in the conferences. So we are working through all of those in parallel with the listing in the US, closing one of the other acquisitions, and also the shareholder meetings and combinations on this. But those are things that we will have to come back on and talk to you again at some point in the near future, hopefully, in terms of what those are.
Yeah. Who would be of you that would come back and talk to me? Essentially, is what is kind of my initial thinking here. Because again, you guys are kind of doing the tour right now as a duo. Is that how you're going to be running the company going forward, or what? Like Dave, you're going to be the CEO, and Fred, you're the COO. What does that mean, though? Who's going to be doing what? How do you divide and hopefully conquer here?
I think both companies come at this from a standpoint that titles aren't that important. A lot of people focus on those. We really work at EMX, and I know Elemental works on a roundtable environment. We're trying to put smart people together to make intelligent decisions. I think initially it's good for Fred and I to go and do joint presentations to you, and this is a great example, and thanks for the opportunity. But of course, over time, we'll divide and conquer. And there'll be opportunities for Stefan as CFO to give presentations on his own, for me, for Fred, for David Baker, et cetera. But initially, I think the market is appreciating the fact that Fred and I are speaking to folks like you jointly.
Yeah. When and where is the new venture expected to be trading?
So we'll have a US listing, and once that's confirmed, we can put out exactly which market and date. But that application's underway at the moment, and then we'll also retain the listing in Canada as well. So we'll have the Canadian and US joint listing.
Did you? I think. What do you think the ticker symbol is going to be Because I heard it might be EL, but it seems like that's taken on the New York Stock Exchange.
So the existing ticker symbol is ELE.
Yeah.
So I think that one is available as well. So I think that would hopefully provide some continuity there as well, if that rolls forward.
Yeah. Yeah, that would make sense. Obviously. Yeah. US listing meaning NYC or NASDAQ or it's, I mean, when you say that, you're not talking about like
those are the two major ones.
Yeah.
And so we're just, I think, being cautious in terms of what we say before we have official approval to say it. But working on that track. And of course, at the moment, EMX have the benefit of having the NYSE listing. And if you look at the royalty space, and especially in that sub 500 million space, every company that has a US listing, most of the majority of the liquidity, it transfers over to that US listing. Mm-hmm. And I think we anticipate that going forwards, the combined company is going to have the majority of our listing occurring on that US market.
Are you going to try and get in front of that by going and maybe marketing to larger funds in New York and trying to get some of that, maybe even passive funds flow? Is it too early to talk about that? Or yeah, how do you see that?
No, definitely. We have a roadshow lined up for the US. I think we're going to do some virtual marketing as well. And one of the benefits of having the bigger team actually is that we don't need to do every single conference and every single roadshow and marketing together. And so I think that will be a benefit in terms of making the most of our time and splitting it. But in terms of the passive funds, it's a really interesting point because for index like the GGXJ, one of the major, we obviously over the threshold in terms of market cap, yep. But I think one of the constraints hurdles you normally have is liquidity, and the liquidity required is about, I think, $1 million a day traded. And at the moment, we're trading multiples of that on a combined basis every day. So we are well over the threshold for that. And I think there's one or two other indices where we would expect the combined company to potentially qualify for. So once that happens, it starts to be a bit of a virtuous circle as well, because that liquidity that you get begets more liquidity, and that can be a real advantage. And I think that for our shareholders, ultimately the owner of the business, the easiest path we can give them to having flexibility to buy and sell their shares and hopefully buy more is to give them as much liquidity as possible. Mm-hmm. And so that's something that should be a real positive coming out of this, and expect that with the index inclusion, with the merger closing, and with that US listing, we should have a really good platform for investors and for people who wish to participate to be able to buy part ownership ultimately of the company in as frictionless and as easy a way as possible wherever they are in the world.
I'm actually just looking at that right now, and your average 3-month volume is actually half of what your average 10-day volume is. So your volume has gone up tremendously after announcing this, obviously. For both of you, more or less, same numbers. Elemental, you're doing over 1 million Canadian now on the 10-day average. And then EMX, I think, let's see what you're doing. So call it 750. Yeah, close to 1.5 million. So together you'd be 2.5 million Canadian, which even
the majority of our volume is on the New York Stock Exchange.
Yes, right.
Our 30-day average trading volume on New York is well over 600,000 shares at $5 a share. So that's $3 million a day.
That's interesting. Yeah. So it should be really no problem to get any of those passive income funds. That is interesting as well. What's
one of the questions we have is, if they absorb 5 to 10% from forced index buying, which is highly likely, where's that stock going to come from? We have a lot of sticky shareholders, so it's going to be a very interesting equation.
What is going on in the meantime with the assets might be interesting as well, because that might get new attention as well on top of all that. Dave, I guess we'll start with you. What are the imminent updates you're expecting from, let's do Caserones, because it's a combined one, obviously, but also Timok and Gediktepe, interesting.
So great assets, all three of those. We're very excited about what Lundin's doing at Caserones. They continue to put out hints and data illustrating strong success from in-pit drilling of higher grade breccia zones. And from a royalty holder's perspective, there's no better place to find high grade than in the pit. So they're doing in-pit drilling, and they put out these cross sections that throw these high grade breccia zones going off into one of the high walls. Very, very interesting. Great to see Lundin being aggressive on the exploration front, which is exactly what you'd expect to see from the Lundin family. And in addition to that, they're also talking about pushing that production up towards nameplate capacity and potentially expanding nameplate capacity. Whereas JX Nippon, when they were operating the mine, were operating about 70 to 75% of nameplate capacity. Mm-hmm. So we're seeing discovery optionality driving production optionality on that asset. In addition to the price of copper performing exceptionally well, price of molybdenum is a key byproduct from that mine, also performing well, key asset for us. And in addition to that, I'll point out that the footprint of this royalty, coming back to my favorite topic about royalties, discovery optionality, the footprint of this royalty is bigger than the city of Phoenix. The gargantuan footprint. There's a dozen copper anomalies that have seen drill holes that have intercepts within this footprint. And the one that the Lundins are talking about specifically is Angelica, which is well within the footprint and immediately adjacent to Caserones and would have operational synergies, of course. And they're talking about that, which was an oxide resource in the past, and they're getting into the sulfide at depth now. And we're very, very, very excited about that. This is going to turn into a phenomenal asset for us. Backward looking, Fred, correct me if I'm wrong, I think our combined royalty revenue is about $15 million pre-tax. With a combined royalty percentage of 1.306% NSR, phenomenal position to be in. All right, so now let's go to Timok. Also phenomenally valuable asset for the combined company. Zijin continues to discuss the favorable drill results that they get in the last quarterly report. They alluded to more success in expanding the lower zone, which last year they expanded by 250 million tons at over 1% copper. That's a major discovery just in the expansion of that zone, right? In addition to expanding the mine life of the two upper zones. So last March, the mine life there was now up to 14 more years from that. And then the MG discovery, which had at one time a dozen drill rigs at surface. I believe now they're down to 10 as they move some of those rigs over to drill more lower zone materials. So there's 4 combined deposits within our royalty footprint there. MG being the most recent discovery, the maiden resource, which is just the beginning, 150 million tons of 1.87% copper, 0.61 grams per ton gold. And the geologists have a twinkle in their eye when we tour there on site, discussing what the long-term potential is of that asset. So this is a phenomenal asset for the combined company. 2 commodities we love, of course, copper and gold. Then Gediktepe, they've successfully raised the money and are working towards the transition from going from an oxide open pit that's focused on the gold and silver to a polymetallic copper, zinc, and silver dominant sulfide deposit at depth. There'll be a bit of a hiatus as the gold peels off and as the sulfide ramps up. We have recently renegotiated the royalty there that will enable the operator to put lower grade oxide on the heap. Because the oxide is essentially very close to being mined out now. So we've reduced the royalty there from 10% to 2.25%. That will enable them to be able to put some of the skinnier ores on that pad and continue production there. And then we've increased the royalty and the sulfide from 2 to 2.25 to help accommodate that reduction. On a NAV basis, that works out neutrally and gives us more long-term exposure to that sulfide deposit, which we think will grow. And we're pleased with their advancement of that asset. So that touches upon the 3 that you mentioned. What's a great person to ask about a couple of the key assets in Australia.
Yeah, I do want to talk about Karlawinda and Benico. Obviously, Fred with you as well. Dave, what's the most kind of overlooked asset that you think you have, where like you're very happy about it, but when you go and talk to people like myself, nobody ever asks you about?
So the most overlooked asset that we have is the immense number of lottery tickets at the base of the pyramid being advanced by $100 million in exploration expenditures annually. And results of that would include the South 32 discovery at Peak, ripping off big drill holes of copper, zinc, and silver. That's the extension of the Arizona mining Taylor lead zinc silver deposit that zones into a copper zinc silver deposit on our side of the royalty line there. where we have a full 2% royalty, unbuyable, not capped. And we're very excited about that. It's a great example of deep portfolio discovery optionality. Another one off the top of my head would be the Viscaria copper, gold, iron deposit in northern Sweden that's moving towards production. They continue to find more good grades at depth. That's going to be a nice royalty for us. The Vittangi graphite royalty falling out of the sky. That's another good example. And all this speaks to deep portfolio discovery optionality. And that's why you want to own royalties.
Yeah. Fred, what about yourself? Again, obviously Caserones is the overlap there, but Karlawinda, Bonico, what's going on there?
Well, look, Karlawinda is, and maybe Karlawinda and Laverton might be the other one I talk to, because I think it's an interesting point when you look at our portfolio. Actually, if you said there were 5 assets, sort of 4 or 5 assets at the top, you might say that out of those, Timok actually planning to massively increase their production going into the lower zone. So that is a producing royalty cornerstone that will get bigger. Karlawinda, producing cornerstone royalty that is going through a 50% plant expansion at the moment. And so that is going to come out middle of next year. That's under construction now. So that is going to come out as one of our cornerstone royalties, materially increasing its revenue production at the same time as the gold price is hitting all new highs. So that is probably going from a 2024 $5 million royalty to a 2026 mid-year onwards $10 million a year royalty, not even accounting for the spot price today. And then Laverton, which is another cornerstone royalty, but actually not yet in production. And this is one of the ones that we added to in the recent acquisition. So we will now have a 2 to 4% NSR royalty over up to 4 million ounces. So we have 2% on half, we have 4% 4% on 2 million ounces and 2% on the other half. And for us, that's going to be a really key driver of growth going forward. It's a $4 billion US market cap operator in Australia, very well known in Australia, Genesis Minerals, previous management put together to combine to make Northern Star. And they have an operating mine there. And they have recently acquired all of this ground immediately adjacent, as close as 15, 20 kilometers away, east of the mine. So I think it hasn't been properly explored for going back now nearly 15 years. And in Aussie dollar gold terms, that is a period where the Aussie dollar gold price has almost tripled in that time. And it has seen virtually no exploration. And now it is in the hands of a very well regarded, very well capitalized mid-tier Australian gold miner with a mine next door that they have already spoken to multiple times this year, expanding themselves. So we will get the benefit there of not just the discovery optionality, where they start exploring and actually making up for the lost decade, but we will also see them starting to put some of those existing resources, 99% of which are on granted mining licenses in West Australia, starting to put those into production at their mill. And then we will have the upside on that, which is the plant expansion, which I think they've spoken to half a dozen times this year, which will be coming down the line, and then they will be increasing the production there. So that's 3 of our cornerstone assets where they are actually currently expanding the mine and expecting substantially increased revenue. So when you talk about, we mentioned it earlier, touched on growth in the portfolio, there's some really substantial organic revenue growth there coming over the next 2 to 3 years from those 3 cornerstone assets that will all be substantially larger and contributing even more going forwards.
What do you think is the? I understand you guys are here to present a bullish picture and all that, and we've managed the conversation well, in my opinion. But what's the biggest risk in the meantime, and between now and getting to that level that we initially talked about, where you're kind of financing your own business going forward? Yeah, what's the biggest risk? What's the biggest challenge? And Fred, we might continue on with yourself, and then Dave, I'll get back to you in a second.
Look, there was a point in the early days when, where we were a company that was so concentrated, and the portfolio, we had a relatively small number of assets, that if something went materially wrong at one of our assets, that's actually a systemic risk to the company. And we got to a certain point as we grew, and I remember thinking, I'm in the mining business and I no longer see our portfolio as having a systemic risk. One of the beautiful things about being a royalty company, we're diversified enough now that I think we could absorb anything. And when you put this combination, the portfolios together, that the portfolio combined that we have, it is so diverse and it is so strong. And the number of counterparties we have the number of existing producing operations we have and growth we have, it's more diversified than most mid-tier miners or even majors could be. And so it's one of the favorite attributes of this company on the downside is that downside protection. So I think the two risks I would talk to generally, and I think these are omnipresent, are individual asset operator risk, where there is an issue with a mine, and that can either temporarily interrupt revenue and operations, or it can sterilize some of the existing resources, or the commodity price risk that we have, where we have direct exposure to the underlying commodity prices, and so that's always a downside risk there. And then maybe the third one, which I'd add, is ill allocation of capital, poor allocation of capital. But I think that if you look at the portfolios today, we're diversified enough across operators, assets. We have commodity diversification, although relatively concentrated to copper and gold. And both teams have individual very good track records of astute allocation of capital. And now we're effectively also going to be marking each other's homework as we work together. And so I think even more likely to protect against that. But those are the general risks, I would say, for a royalty company of our combined size at this point in time.
Dave, you're going to have to get creative to top that answer, but go ahead.
Well, I agree with everything that Fred said, and risks are multiplicative. The mining industry is full of risks, and there's plenty of black swans that land in the mining business. And quite unfortunately, the recent example at Grosberg, the world's largest gold mine and one of the world's largest copper mines, is a recent large example of that. And could something of that nature happen at Timok or Caserones? And the answer is, of course. And Fred answered that question very well, and that, thanks to the portfolio effect, that has less of an impact on the overall corporation. But for Freeport, 40% of their revenue was just taken offline. And quite unfortunately, they lost 7 employees. No one would have predicted that. At least no one that I know would have predicted that. And the mining is a risky business.
Yeah.
Commodity price risk, social risk, environmental risk. In this case, it was engineering failure risk. And, we're ever present and aware of these risks in determining how we move forward.
Well, gentlemen, you've done the unthinkable, managed to endure listening and even responding to my questions for over an hour now, and even survived a couple of my jokes there. So I'm going to let you go here in a minute. But what do you think I'm forgetting to ask you? What did you come here hoping to talk about that I failed to bring up?
Well, I always like to talk about the amount of other people's money that are going into the portfolio, because that's what creates this discovery and production optionality that we all love to talk about, right? And so we're looking at a portfolio that has over $100 million in exploration expenditures at no cost to us, creating those discoveries across 200 assets. It's actually, even more than that. And then hundreds of millions of dollars in mine development expenditures, creating that production optionality as well. That's why you want to own royalties.
Fred, what about yourself?
Well, look, I'd just say that one interesting feature of today's market, particularly in the gold space, is that the long-term consensus price is probably trading at the largest discount to spot prices, certainly that I've ever seen. And I think that it's a fascinating point in history, because if gold prices even just remain where they are, you're going to see, in terms of our revenue base, in terms of some of our assets, the benefits there are not just going to be the direct benefits from the cost price, but it's also then going to be people starting to no longer use $1,600 gold to work out their reserves, but they might be doing a pit shell at $2,000 gold. They might be doing it $2,500 gold one day. They might be doing it at $3,000. But that has enormous benefits in terms of some of the assets and some of the optionality we get there from that higher commodity price. So it's, I think, a really interesting position to be at today, where we are seeing such a big disconnect from analysts sort of backward looking and using those forecasts then going forwards and where the gold price is today. And really interesting opportunity for us when we get to analyze different projects at those levels.
And hopefully it's going to be before long that we get back together and talk about some of those opportunities. Hopefully next time we can do a deep dive on the numbers at that point. So sometime next year. But I really do appreciate your time and thank you so much for doing this.
Thanks, Antonio.
Always a pleasure, Antonio.
Right.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. So unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find a company's official filings, and I encourage you to read and analyze the management information circular, the financial statements, the management discussion and analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."